Welcome to KBRA Podcasts, where we cover topical research discussions, industry commentary, and more. Stay tuned for insight from our knowledgeable team members.
Good afternoon and welcome to our second quarter 2022 Bank Podcast. I'm John Rempe and I'm joined by my colleague Leah Hallfors. This edition of the Bank Compendium includes insights on how the industry is navigating the sharp increase in interest rates so far in 2022, as well as the outlook for bottom line returns, in addition to second quarter earnings summaries on all of our publicly traded U.S. banks.
We also examine key topics and trends that are top of mind and what we're watching in view of the uncertain economic outlook. The compendium includes our quarterly environmental, social, and governance bulletin, where we discuss the progress observed across our rated universe on the ESG front, and also provide a summary of the latest in regulatory developments. So, John, the operating environment for U.S. banks during the second quarter was centered around the sharpest increase in interest rates that we've seen since the Volcker years in the late 70s. Tell us more about how the rising rate environment has impacted U.S. banks year to date.
Yeah, that's right, Leah. So following the initial 25 basis point increase in the target Fed funds rate in March, the Fed has now raised its targeted short-term rate by 200 basis points, including two back-to-back 75 basis point increases, with the most recent coming in July. The majority of our rated institutions have reflected some degree of asset sensitivity coming into 2022. So this resulted in some long-awaited NIM expansion. This, combined with rather solid loan growth, drove some of the strongest sequential and year-over-year net interest income growth that we've seen in recent years.
And it seems likely that the multi-year trend of NIM compression has potentially reached a cyclical trough, one which many expect to continue trending positively for at least the remainder of 2022.
Yeah, it seems that way, and that is primarily what we're hearing from the bank management teams. But despite the likely favorable NIM and net interest income trends over the near term, the outlook for bottom line returns is much more uncertain, potentially involving a number of conflicting headwinds and tailwinds, some that were on display in the second quarter.
Right. Let's talk a bit more about those headwinds and tailwinds, John.
Sure. So first, as noted, the strong results in spread lending businesses drove modest sequential improvement in ROA, but returns were less favorable compared to the year-ago period, which was largely due to higher levels of provisioning in the most recent quarter, as well as largely weaker fee income. As many know, profitability in 2021 typically incorporated significant reserve releases and outsized mortgage banking revenues for those with operations, and both of those earnings contributors have waned during the second half of 2021 and into 2022. Reserve releases have been less common during the year, with most of our banks recording provision expenses in support of strong loan growth in the second quarter. Meanwhile, the softness in fee income business lines continued as higher interest rates and capital markets volatility has resulted in weaker mortgage and market-sensitive revenues. Additionally, we have also seen many companies eliminate or reduce NSF and overdraft fees. So, Leah, with these topics in mind, let's talk about what we're watching for the remainder of the year.
Yeah, well, we haven't seen any evidence of early signs of deteriorating asset quality in 2Q22 bank earnings. And credit quality for KBRA rated institutions and the industry at large remained extremely favorable, with non-performing assets and net charge-offs still trending lower from already pristine levels. Given rapid inflation and dwindling stimulus funds, the health of the U.S. consumer was a focal point during the quarter, though we heard management teams generally pushing back on the idea of a consumer-driven economic downturn for now, and most offered positive commentary about the health of their overall retail borrower base. That said, we continue to believe that a normalization in credit will occur and expect loss rates to increase from the unsustainably low levels seen in recent years.
And considering the greater relative concentration in commercial real estate lending at our rated institutions compared to the super regional peers, we note some pockets of CRE present higher risks, with outlooks for office and retail being a little murky due to the shift to working from home and a potential slowdown in consumer spending. The outlook for office, retail, and CRE remains a focus for bank regulators, as the FDIC recently announced that CRE loan concentrations will come under special focus as a part of its upcoming exam cycle.
A recent uptick in construction and development lending, specifically in the last 2 quarters, and most pronounced in speculative residential construction, also gives us pause. That said, if a recession of any real magnitude does come to fruition, most view the industry entering it from a position of strength, and that's an assessment that we generally agree with.
We are also mindful of the reduced capital cushion at rated institutions as loan growth returned and management teams resumed share buybacks compared to last year. With that said, ratios remain well above pre-GFC levels. It's also worth noting that risk-weighted capital ratios could have declined even further if it had not been for the industry's much stronger earnings in recent quarters, supported by reserve releases, mortgage banking income, and PPP fees, which have all diminished in recent quarters.
After asset quality and recession risks, another key topic of 2Q22 earnings was early indications of how banks' deposit bases have reacted to the precipitous year-to-date climb in interest rates. While we saw many deposit bases improve dramatically as government and monetary responses to the pandemic flooded the banking industry with a remarkable amount of inexpensive liquidity, we view the current rising rate environment as an opportunity to evaluate the durability of the improvement.
Another development with deposits is how changes with technology and advancements in mobile banking may impact the stickiness of the traditionally sticky retail consumer deposits. Also, competition for core deposits from online neobanks and fintechs is more intense today than the last rate cycle. We continue to believe that banks with lower loan deposit ratios, strong core customer relationships, and a higher level of non-interest-bearing balances will outperform peers with less attractive funding models moving forward.
Certainly a number of key topics that remain top of mind as we head into the back half of the year and beyond.
So, Leah, our compendium also includes a quarterly ESG bulletin. Do you want to talk to us about that a little bit?
Sure, John. So each quarter we summarize the latest regulatory developments and also feature one of our rated names and discuss their progress on the ESG front. So starting with the regulatory front, the most recent development remains the SEC's March 22nd 3-1 vote, which was in favor of proposing requirements for climate disclosure on annual statements for publicly listed companies. If adopted, this rule would increase disclosure on Scope 1 and 2 emissions, and in certain cases, Scope 3 emissions. Certain registrants, however, may be exempt from Scope 3 emissions disclosure depending on their size, and the climate disclosure requirements would be phased in based on the type of registrant. If the new rules are adopted, fiscal 2023 would be the earliest year that they would take effect, so initial reporting wouldn't take place until 2024 for larger institutions, and then 2025 for many smaller institutions. Following an open public comment period, the SEC will reconvene to finalize the rule.
So if this is adopted, this presents some questions for the banking sector, just given the complexity of the disclosure. What are the key questions on our minds, Leah?
Well, John, we need to understand what methods and resources banks will employ to comply with these requirements, what their reporting frameworks will look like, what the implementation timeline will be, and also the key hurdles towards implementation, and then the prospect of additional ESG-related requirements from bank regulators.
Great. Thanks for the update, Leah. The ESG bulletin also features one of our rated names, Univest Financial Corporation. Talk to us about Univest and their progress with ESG considerations.
Sure. So Univest issued its first ESG report in 2021, which outlines the company's efforts on incorporating ESG considerations into its operations. Some of these initiatives include a commitment to advancing sustainability, including managing the environmental impacts of its buildings and supporting lending to meet the environmental goals of its customers. Like many community banks, Univest has a strong social mission and is active in fostering economic development in its communities. And this includes small business and other lending. And then also the company supports local communities through charitable giving, volunteering, and promoting financial literacy, as well as providing cybersecurity education. In addition, the company promotes sound governance and operates under an effective risk management framework, which is discussed further in our bulletin, as well as our report on the company, both of which are available at our website at kbra.com. And then, John, I'd also like to remind our listeners that each quarter we feature a different institution in our ESG bulletin and discuss their progress. And with ESG becoming an increasingly important topic, we expect to see increased disclosure and significant developments across the industry for some time.
Leah, I appreciate you walking us through the key observations and themes in the second quarter, which we discuss further in our second quarter 2022 U.S. Bank Compendium, which is available on our website. As always, we want to thank our listeners for tuning into KBRA's Bank Podcasts. For more in-depth information on the topics discussed today, as well as summaries on all our publicly traded U.S. banks in our rated universe, please check out our compendium research piece at www.kbra.com, where you can also find all of our research. We look forward to speaking with everyone again next quarter.
This concludes our episode. Please continue the conversation on LinkedIn and Twitter at Kroll Bond Rating. We'd also like to remind you that all of our ratings and research reports are available at kbra.com. Lastly, please share any feedback or ideas for future podcast episodes by emailing us at media@kbra.com. We hope to see you next time.